All right, we're on video for capital budgeting. And as I mentioned in class, capital budgeting is the process by which companies decide which projects that are brought forward by their various divisions should get funded or not. And obviously, since we're in a finance class, we're going to look at this from the standpoint of the financial returns, return on investment, things of that sort, rather than anything that would be related to the strategic value or tightening their relationship with their supply channels or their customers. All of these are relevant reasons and may overcome the financial parameters. However, we're going to stick to finance and look at the nuts and bolts of some financial analysis. All right. So first, let's look at the objectives. We're going to look at capital budgeting basics just to familiarize ourselves with the process and the types of things that we're likely to see. Then as far as methodology, we're going to see all types of tools today. We're going to look at net present value, the internal rate of return, the modified internal rate of return, the profitability index, payback, and discounted payback. Then look at some complications that are common in real life, such as unequal lives of different projects. And finally, looking at the economic life versus the physical life of certain assets. So we have a lot of work to do in this particular module, and we'll be going through quite a few examples in Excel. So the comic on this particular chapter is I need a budget estimate for my project, but I don't have a scope or a design for it yet. Okay, my estimate is $3,583,729. You don't know anything about my project. Well, that makes the two of us. So this is a famous comic strip called Dilbert. You may have seen these before, and it shows kind of some ludicrous aspects of corporate life. Capital budgeting is certainly one of those. All right, so we've seen these types of flowcharts before, but the difference here is we're now at a project level, whereas before we were doing valuations of stock or valuation of operations. Here we're doing the valuation of a project. So again, the format is always very similar. The CFs here are from the project themselves. The denominator is 1 plus R. R is simply the risk-adjusted cost of capital. Now this may be the WACC of the company, or it could be an adjusted rate based on the risk of that particular division or that particular project. We mentioned this a bit when we were looking at WACC, but now we're in the chapter which utilizes project-based rates of return. The budgeting basics. So what is a capital budget? They're potential projects where they've been brought forward by management or perhaps staff, and these are some of the most important decisions that companies make. So it involves a lot of senior management contemplation and consideration because it deals with the strategy of the company, it deals with near-term profitability, it deals with large amounts of money, and can dictate the future of a company. Mistakes made and where people put their money and management time often is a you bet your company type of scenario. So one of the major demarcations in terms of consideration is it mutually exclusive or independent? Now this just sounds like words for now, but they're quite important. Independent means if you have 5 projects, that means you could do each of the 5 or any of the 5 individually or collective because they don't rely on each other. Mutually exclusive means you may have an objective and you have 2 projects that are alternative ways to deal with that particular opportunity. So you have project A, and if you do A, then you can't do B. If you do B, you can't do A. So that's what we mean by mutually exclusive. As opposed to the earlier one, you could do A or B or A and B. It doesn't matter since they are independent. So the steps that we'll use in capital budgeting, first we'll estimate the cash flows, surprise, surprise, and we'll look at them again being very careful on the sign. Is it a positive inflow or is it a negative outflow? Then we'll look at the risk of the cash flows, and that determines the rate. And it could be WACC for a project, or it could be an adjusted rate of return. Then we'll do evaluation of cash flows. This step number 4 is pretty vague because we're going to use different tools to do the evaluation. Some are based on time value of money using NPV and IRR. Others are just plain old cash, such as payback method. So we'll look at those, and these are all used pretty commonly in practice. So let's try it out. So first we have 2 projects, L and S. L is kind of a long-term waiting for your money, and S is a short-term, you're getting your money faster. So if we look at the cash flows, they both start with a negative 100 at time 0, as in today. L has 10, then 60, then 80, so you have to wait longer for your money. And S is 70, 50, and 20, so you get your money sooner. I guess it could be sooner and later too. and which project is more profitable. Their cash flow patterns, as you can see from this graph, are quite different. Let's start things very slowly and let's look at the cash flows. So when we go to Excel, we can see that plain old cash, we'd say, well, it equals the sum of 100 out to 80. So the first one makes us $50, and the second one makes us $40. So on that basis, this doesn't look too good. This is only $40. This looks better because it makes us more money, right? So on this basis, we might say, well, this is pretty easy. We'll rather have $50 versus $40. However, you're smart enough to know that we have to consider time value of money. So let's go back to our slide deck and just build our story. The next case is looking at NPV. Just as a brief reminder, NPV is how much profit would I make if I consider that money now is worth more money than money a year from now. And you'll recall this formula where we have net present value equals the sum of the cash flows discounted back at some discount rate. And so one of the things we want to notice is that if the NPV is positive, that means the cash flows overall, including our investment, based on the yield that we need from our investment, is greater than our required yield. So positive is good, which means we make more than our minimum. Negative NPV is bad, which means the project cash flows do not justify our investment. NPV equals 0 means it exactly equals our target rate of return, and although it's pretty small difference or marginal difference, we may choose to still do the project because it does meet exactly the minimum threshold for our project. Excel, this is a quick refresher, and I don't want you to feel insulted because we've done this a few times, because there's a very, very common mistake made here. So let's look at this hypothetical cash flow of T0, 1, 2, 3, with 2 negative cash flows and 2 positive. And the thing you have to remember is the net present value always starts with T1. And T0 is not part of the NPV function. So the way we would figure out NPV is really broken into 2 sections, and you could put it in one cell, or as we do here, just to break it out to make it very clear, they're 2 distinctly different pieces of the NPV calculation. First, let's do the NPV. In this case, equals NPV, discount rate of 0.09, and we're going to do years 1, 2, and 3. Times 0, we're going to put as a negative 987 to be offset against the 1,620 as the NPV of the positive cash flows. So the net is 633, positive sign. So that it's a positive sign means it's a go in terms of project approval, or at least meeting project minimums. If it's exactly 0, it means it exactly meets our rate of return. So 0 is not bad. That's a common misnomer. If it's negative, that's bad. It means it does not meet our target return, in this case of 9%. All right, so let's try with L and S. So we'll go approach number 2, discount rate is 10%, and you'll recall equals NPV, and I'll do it the slower way, breaking out the components. So 10% is the rate, and I'm only going to grab years 1 and beyond. And then I'm going to show that there is a negative cash flow of 100, and so the net present value is $18. All right, at least it's positive. So let's do the same thing here for project S, and so equals NPV, open parens, we want the rate 10%, comma, shade the range for T1 to the end, close parens, enter. So 119, again, we have to consider the initial outlay, and the net present value is 19. So this amount versus this amount. So now we see that in the first case, I guess we should stick to our approach. In the first case, L was better. In the second case, now we're seeing that this one is better. So now if we do NPV at a discount rate of 10%, we'd rather do project S. And that's because money sooner is worth more money than money later. And here the $70 is front loaded in the S, whereas the $80 is back loaded on the L. And that's kind of the reason that it flipped on us, where it was just a simple summation or the total for the cash only. Now, when we consider time value of money, we're weighting it based on the discount factor, what we call the rate, 1 over 1 plus the interest rate raised to the power of years, right? That's essentially what NPV does for us for each of the years in the cash flow range. All right, so now we're going to go to the next step, which is, what is my rate of return? And this is the IRR. And I mentioned this before, but people who are not finance people often like IRR because we, in our normal life or somewhat normal life, look at, well, we put money in the bank and it earns this percent of interest. Or we put money in the stock market and it earns this percent of returns for our stock. So it's an intuitively simple idea. And then you compare the IRR, which is from the project, to your requirement, which is like a hurdle. And if the IRR is higher than your hurdle, that's good. You jump over the hurdle. If the IRR is less than your hurdle, not good. You fall into the hurdle, right? And not good. So that's the concept of an IRR. It's the rate of return that is embedded in that system of numbers, that series of numbers. And it constitutes one number that evaluates all the cash flows for a given project. When we look at this in Excel, this is a quite simple function in Excel, thank God. It simply equals IRR, and you shade from T0 to the end of the cash flows. There are common mistakes even in an IRR calculation. Many of you may have been frustrated where you did everything right, and you put equals IRR, and you forget that T0 has to be a negative number, or at least one of the numbers has to be negative, right, whenever the cash is invested. So look at this example. T0 is a negative 987. T1 has an additional investment of 100, and then T2 and 3 have positive, and that makes it eligible for a rate of return. And so when we mash together the system of numbers that are these four numbers, the rate of return embedded in that is 28.45%. All right, so that's IRR and how Excel works. So let's try it. Let's use the same example of L and S, and we'll calculate our IRRs. So going back to our cell, we'll unblock the next approach, which is IRR. This, as I mentioned, is super easy. Equals IRR, open parens, and shade the entire set of cash flows, making sure you're capturing times 0, making sure there's both negative and positive numbers for outflows and inflows, and we get 18%. We do the same over here. Equals IRR, open parens, shade from T0 over to the T3, and get 24. So once again, we like the short-term one better. Let's do the shading of this one. And once again, the better one is S. So S appears to be a better project when we consider the time value of money, and it generates a rate of return of 23.6% and an 18.1% for L. So let's pause for a moment and just critique or reflect on what we just saw. Let's say you were in charge of presenting to some non-finance people. And the question is, which one should we fund? Should we fund L or S? Here are two different approaches, one using NPV and one using IRR. And you tell me which one's easier to understand. All right, let's start with the first one. Using the NPV approach and a discount rate of 10%, Project L will return $18.78 thousand, which is a favorable result because it's a positive NPV. However, when we fund Project S under the same 10% discount rate requirement, we will get a NPV of 19.98. So therefore, the NPV of S is greater than NPV of L, and we should fund Project S. All right, so that's NPV. It's a pretty straightforward way to describe it. All right, let's do the other one, IRR, and we'll start right now. All right, we're evaluating Project L and Project S. Project L has a rate of return of 18%. Our hurdle rate is 10, so it clearly goes ahead or above our minimum. Project S earns 23.6%, which is quite a bit more than our 10%. So we recommend Project S, even though both of them are favorable projects for us. So what I'm illustrating is that the normal non-finance person is much more comfortable with an IRR description or a discussion than an NPV. However, for reasons we'll show later, most finance professionals prefer to analyze using NPV. And as I may have mentioned in your class, that I use NPV for the analysis, but I often will use IRR if I'm explaining it to non-finance people. So that's kind of how I've approached this over time, because both has its place. All right, back to our examples. So we just computed the IRRs for L and S and determined that S had a higher IRR. So the next thing we'd like to do is see if there's sensitivity to the rates of return. And this is just a grid that's going to set up our next piece of analysis. Is we had used a 10% IRR, and in that particular case, we rather have the money short term versus a slower money, a longer term money. So what if, however, we change that assumption? Instead of 10, we'll go 0 and 5, or go above at 15 and 20. What happens then? So let's hop back into Excel and unblock the next section, which is the sensitivity. And so the formula is equals the NPV, open parens, the rate, and that's this number, comma, and the positive cash flows. And I'm going to make sure I close the parens and go outside of the function to capture the T1 cash flow. Right. The other thing I'm going to do is to make it so I can copy this formula below. So I'm going to look at the function. I want the rate of interest to be relative. However, I want this one to be locked, and I want the end year to be locked, and I want our initial investment to be locked. So when we do that, we can simply copy it, and we get the results. So we see that it's $50 with 0 discount rate, which is exactly the same as what we did, and we just added the numbers together. That's what 0 means. There is no time value of money factor. And then we saw right above 18.8, which is this number here, 18.7. So that's the same result. However, we see that at 20% discount rate, this project goes negative, right? And we kind of know that because the IRR was 18%. So we have some indication that anything above that as a discount rate would make it not a productive project. So let's do the same for project S. So equals NPV, open parens, the rate, comma, and this time we'll lock as we go. Cash flows are here, and we'll add this number, and we'll lock that one, and we'll go back in and lock the cash flows. Okay, and we can now copy that. And we see that it starts at 40, which again is the number we saw way at the beginning when we did plain old cash. And we also went to 10% and see 19.98, and we see this particular item. All right, so these are numbers, and what we're going to do next is plot them back in that chart that we saw earlier and see some interesting results. And it looks like this. So we see that the NPV, if we're at a 0% discount rate, favors us getting money later. Also, at a low interest rate of 5%, it also favors the project L. However, somewhere between 5 and 10, it flips, and project S becomes superior because the time value of money is high enough so that we value the earlier money more. So that's an observation that we could see with the NPV that we cannot see with the IRR. The IRR simply shows the embedded or the implied rate of return given the series of cash flows. Now, if we plotted those on a two-dimensional axis, where the horizontal axis is the discount rate and the vertical axis is NPV, and this is just the data we saw on the prior slide, we see a crossover point. What the crossover point represents is if the rate of return is higher than 8.7%, then S is better. If it's lower than 8.7%, then L is better. So this is one of the differences between NPV and IRR, that because of the different discount rates, we can actually compute the point at which one project is superior to the other. So in this case, if the discount rate changes, we may change our mind whether we recommend L or S. However, for the IRR, we would never change our mind. We'd always say that S is better than L. Okay? So that's an observation. If we were to try to find the crossover rate, and I'll just show you this here, I won't do it in Excel just to speed things up. We just lay out the two projects. Here you can see project L and S, one right after the other. We pull the difference and we run the IRR of those differences, and that constitutes the point at which they're equal. And so the crossover point occurs, as we saw in the prior slide, at 8.7%. NPV versus IRR. I mentioned earlier that finance professionals tend to prefer NPV, and it uses a very precise, or hopefully precise, rate of return, and that could be WACC or some adjusted WACC rate. However, IRR is more understandable by business people or non-finance people, and that's what I illustrated, I hope, in my prior example. And one of the issues with IRR that is a technical and perhaps very relevant difference is there's an implied assumption that every dollar in the IRR range of cash flows earns exactly the same rate. Now that's okay if it's a relatively low rate, let's say 8 to 10%, but let's say there's a project that's very productive and it has like a 20 or 30% IRR, which does occur. The assumption is that any cash flows that are received during the project life can be reinvested at exactly that same rate. And that's just not feasible. Like if you had been fortunate enough to fund a project, let's say for $1 million, and it starts generating cash flow that is quite substantial in years 2, 3, and 4, and you get the money. Well, the likelihood of you investing in a project that yields that high a return is actually pretty small. So this is what we call the reinvestment risk issue, is that the project as a whole can show an IRR that's quite high, but it assumes something that's unreasonable, that all the cash flows that you get from the project can be reinvested at that same high rate. So to address this issue, we do one fairly simple refinement of the IRR, and that's called a modified IRR. Not too imaginative, but it's descriptive, modified IRR. So we're going to talk about that, and then we're going to show how we could do it in Excel very, very easily. Let's start with the concept of how it works. So it's the rate of return of a series of cash flows where the inflows are reinvested at a specific rate. And what that means is that we could have two rates, or we will have two rates. One rate that is the reinvestment rate, so that when we're getting all this money, we can put it in at a lower rate. So let's say our project earns 25% and we get cash flow in year 2. Rather than assume that that can be reinvested at 25%, we're going to specify a rate of return that is what we call the reinvestment rate. So let's say, oh, we're going to stick it in a bank or stick it with our treasury department, and they can earn us 10%. So now you see the value of the modified IRR. It assumes that cash inflows are invested at one rate, namely 10%. And then we look at the overall project returns and say what rate of return does the project as a whole generate without the assumption that every single cash flow is at that same rate. So the math here is a little bit complicated, but it illustrates the logic. First, we determine all the cash outflows, and that's the money that goes out, and we're going to charge that at a rate of a financing rate. Now, if the cash outflow is at time 0, it's moot because there is no difference in time value, but I just want to park that in your mind because when we look at the Excel function, it does consider that. Second, we're going to look at all the cash inflows, and then we're going to invest those at the reinvestment rate. And the picture here on the right side here represents that T0 is negative 100, and that's the outflow. So that just comes through as today's dollars. And then T1, 2, and 3 are pushed out into the future at a 10% rate. Now we have a PV of outflows and the inflows. Now we can figure out what is the rate of return in between those. If we outflow this amount for T0 and we have an inflow of this amount in year 3, what is the rate of return? between one single payment and one single payment, ignoring that there's anything in between. And so in this particular case, the answer of the modified IRR is 16.5. Now that's a lot of legwork to do to get this relatively simple number. So we're going to do something a little different. We're going to use Excel. Excel has a function, MIRR, that does all this heavy lifting for us. And there's only 3 parameters in the Excel function. The first is the cash flow series, of course, starting at T0, going out to T, or the end of the time of the cash flow. Then we have to specify what is the financing rate. Financing rate is how much money you pay when you borrow money for the negative cash flows. Then we specify the reinvestment rate. These are the savings rates for the cash inflows that we then take in, push all the way out to the end of the life of the project, and run this MIR function. So we're going to use the same example of negative 100, then 10, 60, and 8, and look at the MIRR. So we'll go back to our example, and we'll open the section, MIR. And so I could just do right here, equals MIRR, open parens. Again, it prompts us what are the values for the entire period. Then you go comma, what is the financing rate? And in this case, we're going to use 10% for both. It's actually moot for the financing because we only have one negative cash flow. And so that's 16%. If we make it with more digits, it's exactly the same as what we saw previously. We could also do the MIRR for the other project. MIRR, open parens, shade the cash flows. Do the financing rate, comma, reinvestment rate, close parens. You get 17%, and let's again make the formatting consistent. 16.89, right? So both the IRR and the MIR are superior for the project S. All right, back to our PowerPoint. We can then now look at yet another method. As I mentioned, we're going to look at a lot of tools here. This is the profitability index, and one way to think about this is which project gives you the most bang for your buck. And so the numerator is the present value of all the cash flows, and the denominator is your initial cost. What we say is for every dollar of our investment, how much money do we make on a present value basis? All right, so that's the answer. The 2 little boxes below, we get all the cash flows, and we pull the PVs. We all know how to do that, right? We've done that many, many times. Then the calculation of the PI is the present value of the future cash flows as a numerator. In this case, we sum these 3 cash flows to get 118.79 divided by the initial costs. In this case, it is the $100 that we saw as our outflow. And the PI is 1.1879 for the project L, and it's 1.1998 for project S. So let's go to Excel and just prove how to do this. Again, we will open up the next spot, and we say the discount rate. What's the PV of the inflows? So here equals NPV. We can do this because we conveniently have all positive cash flows after T0. So the rate is 10%, comma, and these items here. So that's the present value of cash flows. And then the cash outflow is $100. And so therefore the profitability index is 110 or 18 divided by that, 1.8, and we got the same number that we just saw. If we do the same for project S, equals NPV, open parens, discount rate, comma, the cash flows from T1 to 3, close parens, the initial outlay, it's $100, profitability index is 119 divided by 100, that's just 1.1998, which again is what we saw here, right? So that's how we derive it. It's quite simple. One NPV calculation, the denominator is the present value of the outflow, and we get the index. So interpreting it, for every dollar we invest in capital project L, we will get $1.18 for on a present value basis. For project S, for every dollar we invest, we'll get $1.20. So therefore, project S is superior. That's how we would use the profitability index and explain it as far as recommendation. Next, we'll look at some simplistic, maybe crude methods, but again, very intuitive to people that are not finance people. And this one simply answers the question, how many years are going to be required for us to get back our money? That's as simple. If I put in $100,000, how long will it take me to recoup that investment? And that's all it is, just getting back to break even. It doesn't mean making money. It just means getting back our money. All right. So here we'll have our same projects, L and S, and we'll figure out what is the payback period. Then we'll compare them and see what makes sense. So this one, there's a method to it. So I'll show you. So first thing we notice is that in time 0, we spend $100. So I'll write here cumulative. And at the end of time 0, I'm negative $100. Right? Now, at the end of year 1, I am now better off. I had $100 initially, but then now I've gotten a 10. So I'm now at negative 90. All right, so I'm getting back my money. Next year, what happens? Well, I had negative 90, but I made 60. So I'm now at negative 30. How about the next year? Well, I started negative 30, and now I added 80. I'm positive. So this is what's really important to notice, is that during some time between years 2 and 3, I went from negative to positive. And so the way to figure out what that is would be to say, okay, I made $80 in year 3. I needed $30 to pay back, right? I needed 30 of the 80 to get me back to even. So therefore, I need 30 divided by 80 as a fraction. So the fraction is 0.375 years. So I need like a third of the year of year 3, when added back to years 1 and 2, will pay back for my $100. So the answer to this is payback period equals, and the answer would be 2.375, because these two were the first two, and we add this little extra between years 2 and 3. So let's do the same calculation here. So it starts off at the same. So again, this is cumulative. And at the end of year 1, we are now negative 30. At the end of year 2, we're positive. So let's stop, right? So in between these two is our sweet spot. So I needed 30. So I need 30. And how much money did I make in year 2? I made 50. So I need 0.6 of year 2 in order to do our payback. So payback period equals, and here it's 1.6, right? 1 year here, and this little extra here from year 2 to get 1.6. So this again is the superior result, right? I'd rather get my money back sooner than later. So that's payback period. Now, does it make sense? So let's look at the numbers and say, I get my money back faster, but what you notice is that later on, I'm going to start making more money. So it is possible that if the projects go on beyond year 3, it may be that project L is better because it's still exiting year 3 at a pretty high cash flow, whereas it looks like project S may be running out of steam here, and it's going to drop off, right? We don't know that. It's just something we observe, because but on a strict basis of payback, we get our money back fastest using the payback from project S. All right. And that's what this is, just illustration using graphics. So next is strengths and weaknesses. Strength is it's an indication, and it's easy to understand, easy to communicate, and a lot of salespeople sell B2B products using this type of logic. Weaknesses is that it gets you to 0 fastest, but it doesn't say what happens after that. So if something just goes on and on and on and keeps generating money, so you can hold it for 20 years and it generates money, and the second project gives you your money back in 2 years, but it dies after year 3. Well, it may be nice to get your money back faster, but it doesn't keep going for years and years and years. So you forego the consideration of the upside. You're only trying to get your money back. So it's a very kind of risk-averse way of viewing things. Next, and most importantly, it ignores time value of money. We all know that money today is worth more money than 10 years from now. And the whole payback period ignores the whole stream of cash flows and therefore is really kind of flawed in that it only looks at near-term cash flows necessary to get you back your money. The other issue is there's no guideline for an acceptable payback. Now earlier we had a hurdle rate that was a weighted average cost of capital, but here we have no such thing. So if we say, okay, it's 1.6 years, I don't know, is that good or bad? Or 2.4 years, I don't know, is that good or bad? There needs to be some judgment or management policy to accompany the computation of payback to make it usable at all. All right, so there is a way to address the critique that payback ignores time value of money, because I'll just do it through illustration here. Here are the cash flows, 100, 10, 60, and 80, and we all already can do the payback. So we know it's 2.375 years, right? So it's 2 years to get to negative 30 and 0.35 to make up that extra 30, so 2.375. Now, if we do the present value of each of those cash flows, and we now go negative this, then cumulative, cumulative, and bingo, it moves out to 2.7 years from 2.3 years. So it's a refinement. I don't really like this one, honestly, because it still ignores the future. And if you're going to go through the trouble of doing net present value, why don't you do it right through using an NPV formula or IRR. So I'm not even going to show you this on Excel. All right, next is normal versus non-normal cash flows. So what we're talking about here is normal would you pay money out early and then you get money back later, right? That's a normal cash flow. And there's one change in signs, right? You lay money out, that's negative, and you get money in from that point on, positive. And all the things we've been doing on investments are essentially like that. But what if it's non-normal? In other words, there are two or more changes in signs. And so an example would be you have a negative outlay, then you make a little money, then you have another big negative outlay, then you make a little bit more money. So it's bouncing around the cash flows. An example of this would be something that requires a very expensive refurbishment or renewal during the life of a project. An example here would be a nuclear power plant, right? Clearly, after a certain amount of time, we have to do heavy maintenance and do things to make sure the rods and the containment is all done properly. So that could be a very major expenditure. The other one is a strip mine or an oil rig, let's say out in the North Sea. It costs a lot of money to drill the initial platform in the North Sea, but after a while you have to refurbish it, and that's a major, major expenditure. So those are examples. When we have these kind of abnormal cash flow, we may have two or more internal rates of return because it depends on the different phases of cash flows in which we're operating. And MIR brings off positive cash flows back to a terminal value. So it's actually a way to address this. So for a non-normal cash flow, NPV works. NPV almost always works. But if we want to use MIR, it would also work because it's normalizing all the inflows and outflows and grouping them into those categories and then computing the MIR that equates the PV to the FV. So we have two choices in non-normal, NPV and MIRR. All right. So the next challenge is what if we have different periods of time for two projects? In the LNS, we had the exact same time period, but look at this one. We have T and F. T is a 2-year and F is a 4-year, and we have this cash flow. Negative 100 outlay for both, but the lifespan of the first one is 2 years and you get $60 a year. The lifespan of the second one is 4 years and you get $33.5. So again, let's start with basics and let's do an NPV in this case. So here when this next tab, if we do the NPV, let's do it for project T, equals NPV, open parens, discount rate is 10%, comma, and go out to T1 and 2, close outlay is $100, and NPV is that plus that, or $4, all right? So let's go out to F, and F is equals NPV, open parens, 10%, comma, years 1 through 4, close parens. We have an outlay of $100. So we make $6. So here we would say, well, let's make these a little bit bigger. Well, I'd rather have $6 than 4, so that's a no-brainer. We will do this one, right? Versus this one. But there's a problem. We have one that's 2 years and one that's 4. So we're kind of comparing apples to oranges. So how do we address this issue before we make a decision and recommend the second project, the 4-year project? So one approach is to look at making it equal in terms of annual annuity. So this is the idea where we know there's lumpy cash flow and different irregular cash flow, but let's assume that each project generates a set amount of monthly every year, which is what an annuity is. It's a payment inside of a present value, future value calculation. So here the steps seem a little bit illogical, so I'm going to stay with me. So the first thing you do is you determine the NPV of the uneven cash flows. Then you use that number as the PV, and then you specify the last year as T with a 0 future value, and then you force the computation of what payment draws down that present value back down to 0. And that's what we're doing. So I'll show you that in Excel. That might make more sense. But I must admit this one most students have a harder time visualizing. So let's just do the calculation. That may help. So the NPV we already determined was $4. And the EAA is, okay, if I want to figure out the payment, PMT, open parens, the rate is 10%. That's right there, comma, what is the number of periods, and in the case of this project is 2 years, comma, what's the PV is this number, the NPV, comma, what's the FV? 0, close parens. So the answer is $2.38. All right, so let's look at project F. So let's do the same thing. The NPV for project F is $619 and is equal to the rate, which is 10%, comma, the number of periods. In this case, the number of periods is different. It's 4 periods, comma, the PV is the NPV, comma, the future value is 0. So we get 1.95. And so in this case, even though the NPV is higher for project F, notice that the equivalent annual annuity is actually not as good. And that's because even project T has less NPV, but you're over in 2 years. Whereas for project F, you have to wait 4 years to get your return. So that's why on an equivalent annual annuity basis, the superior project is actually project T. So that's a way to look at it. It factors in the time period over which you must earn the money under project T versus project F. All right. Okay, so now we'll look at another approach, which is called the replacement change, or we repeat the shorter project again so that we can equalize the time difference. So let's look at this, and we have to do a little formatting here. So project T will capture the first two years, copy, put it here. So we see one project of -100, 60, and 60. Then we do it again. We say, okay, let's copy that, and at the end of year 2, let's do it all over again. So at the end of year 2, we'll invest another 100 and get 60 for the 2 years after that. Make a little room here. And so we now have not one project, but projects kind of linked together. So the total cash flows would be as follows. So now instead of having a 2-year project, we now have a 4-year project. 100, 60, net of 40, then 60, 60. Project F is unchanged. It's still a 4-year project. And notice that we now have apples to apples. We have one 4-year project compared to another 4-year project. Now we can pull the NPVs. So let's do project T, and the NPV equals NPV, open parens, discount rate, it's not 0.4, 0.1. So equals NPV, open parens, discount rate, comma, and we go here from T1 to T4, close parens, and we'll factor the $100 investment. So it's $755, and project F is equals NPV, open parens, the rate, comma, and now we go years 1 through 4, close parens, take into account the dollars spent, and it's $619. We've seen that number before above, but to put it side by side. So now it flipped. So where project F, if it was compared to a 2-year project of project T, it would beat it by $619 versus $413. However, if we link together two project T's, which has the same time frame as one project F, it flips, and we're better off doing project F. Inherently, what the two methods show us is that project T is actually a better project. However, it's just over too quickly. So the EAA shows that by saying what's the equivalent annual annuity, and also this idea of replacement chain also shows it, that we're better off with two sequences of project F or T rather than one sequence of project F. Alright, so that is replacement chain. So the final topic is economic life versus physical life. And here's where we have a piece of equipment, let's say, and we're using it, and all the time we're using it is generating cash flow. However, the project itself has a salvage value. So we're saying, when should we retire the asset? So we're going to look at cash flows. So this is a new scenario with years 0, 1, 2, 3. Year 0 is the outlay initially of $5,000, and that's what the project or the equipment costs us. At year 1, it generates a good amount of money, $2,100. Next year, $2,000. Final year, $1,750. But notice that the salvage value, as you would expect, would decline as it gets older and older, from $5,000 to $3,100 to $2,000 down to 0 at the end of year 3. So now we're going to subject this to a little bit more scrutiny and analysis using net present values. So what we see is that we have some scenarios. So we have a scenario where we hold it for 1 year, and let's do the cash flows. So the cash flows for year 1 would look like this. We have to pay for it and get 1 year, and then at the end of year 1 we get money. We sell it and get $3,100. So the cash flows would be $5,000 for year 1 and $5,200 for year 2. So equals NPV, discount rate of 10%, comma, it was plus 5,000. So 273 is the negative in this case, cash outlay. So let's do 2 years. So 2 years is we get these 3 specific numbers, copy that, row, and then notice that we're now out here. How much money will we get here? $2,000. So plus that, copy that, and we could do the NPV equals NPV and rate, still the 10%, comma, years 1 and 2, close parens, plus the outlay, and we're now 215 positive, right? So that's a better proposition so far. And let's say we hold it for 3 years. So we'll get all 3 years of cash flows, and we get a salvage value equal to 0. And so the cash flows are as follows, and we can do the NPV equals NPV, rate is 10%, comma, cash flows, and outlay, keep it outside, and it's negative 123. So here we see that even though we could see this normal pattern of declining value for a piece of equipment, there's a clear advantage to selling it in year 2 because we would actually maximize our cash flow. So we get 2 years worth of value from it. We get to recoup a fair amount of salvage value of $2,000 and get rid of it before it becomes useless. So that's an example of economic life. The economic life of this particular machine is 2 years, whereas the physical life may be 3. So summarizing this chapter, we looked at the basics of budgeting, like when it occurs and why. We looked at many methods of evaluating projects, strictly cash basis, just adding the numbers, a little bit more sophisticated using time value of money with NPV, using alternatives but quite commonly used metrics like IRR and MIRR. Then the other is using a blend of a NPV and kind of a simple notion of using profitability index. Then we look at a very commonly used method called payback method, which doesn't consider time value of money at all. And we also refined it a bit to make it a discounted payback period, which I consider a bit of a waste of time. I like payback. Just do it for a quick and dirty estimate. Then after you're done with that, it looks pretty good. Then subject it to more rigor and do NPV. And if you have to explain it to non-financial people, then use IRR so they can understand it. I mean, that's probably a practical way to think about this. Next, we looked at some variations. One is what happens if the projects have unequal lives. And we looked at two methods. One is the equivalent annual annuity approach, where we pick the higher number. And the second is where we could chain together, called replacement chain approach, the one of the shorter lifespan so that we can make the time spans for the two projects comparable. And finally, we look at the economic life of an asset versus its physical life, and found that sometimes the economic life has high value prior to the expiration of the physical life. So that's it for this chapter, and I will see you guys in class. Thank you. Bye-bye.